We'll use a hypothetical example to illustrate pro forma financial statements. So these for 2000 X1, these are actual financial data for this hypothetical company, Derrald Company. So these are the actual financial statements at the end of 2000 X1 or the start of 2000 X2. So we've got total assets of 560,000. Therefore, we've got total liabilities and equities of 560,000. The income statement last year, so this already happened, net income was 40,000. So these are the financial statements that happened last year. So these are not pro forma financial statements. These financial statements are actual financial statements from last year. This is last year. So this is our base. This is our point. Give me the financial statements this year, the balance sheet and the income statement, and I'll use that as the jumping off point to forecast what the financial statements will look like next year. If I'm a bank, if I'm a potential investor, this is nice, but this is more nice if I can use these to forecast what's going to happen next year. The starting point in building any forecast, any pro forma financial statements, or any budget for that matter, the starting point is always the sales forecast, the forecast of the volume of activity. How big is our business going to be? So how many workers are we going to need? And how many buildings are we going to need? And what are we going to be spending for advertising and this and that and the other thing? It all comes back to the sales forecast. And the most difficult part of creating a pro forma financial statements is generating a realistic sales forecast. And I want to put a couple stars here because what I'm going to illustrate here is give me a good sales forecast, and with some simple assumptions I can generate, and you will be able to generate some forecasted or pro forma financial statements. But the hard part is getting the sales forecast. Accountants, that's not the expertise of accountants. So marketing people are going to come in, people who can do economics, people who can do analysis of markets, they're going to be the ones that are going to generate the sales forecast. And the validity of the pro forma financial statements rests primarily on how well was the sales forecast done, because the rest of this is technique in applying what we know about accounting, but the real business judgment comes in, and the real risk comes in making the sales forecast. One of my favorite examples of how far off a sales forecast can be goes back to 1950 in IBM. I'm just going to read this to you. I wrote this a number of years ago. This is fascinating. So in 1950, resistance to the idea of electronic computers was high inside IBM. See, IBM's engineers were specialists in electromechanical devices, machines that moved and gears and all this kind of stuff. And they were uncomfortable with working with vacuum tubes and diodes and magnetic recording tapes. So the whole idea of electronic computers, that wasn't their specialty. It wasn't their forte. In addition, there were many questions about the customer demand for electronic computers. My dad worked on computers back close to 1950, and these things were huge. They were the size of a gymnasium, and they smelled funny, and they used a lot of electricity. And the computing capacity of the biggest computer in the world back then is probably about the same as the computing capacity of your watch, if you've got a watch on now, or maybe your watch has more computing capacity. So one IBM executive back in 1950 forecast, speaking against IBM going into this electronic computer industry, this IBM executive forecast the size of the worldwide market for computers was no more than 5. 5 computers is all the world needed. This IBM executive forecast. They were a little off. Probably between you and me and your phone and your iPad and whatever else you've got, probably between the two of us, we've got 5 computers just ourselves. But back in 1950, this IBM executive, the worldwide demand is no more than 5. Well, that was a bad sales forecast. There are a few more computers than 5. If you made a pro forma financial statements based on that sales forecast, you might have done the process perfectly correctly, but since it was based on a bad sales forecast, it wouldn't have been good pro forma financial statements. My point is this: if you're going to prepare pro forma financial statements for a company and deciding whether to loan money to the company or invest in the company, it all comes back to how good is your sales forecast. So time spent in doing this, which is not accounting, this is marketing, this is economic analysis. Time and money spent getting this done well will pay off in a much better set of pro forma financial statements. There are some simple ideas in preparing pro forma financial statements. First, let's talk about the balance sheet. Some things just go up naturally. If I've got a bigger business, I need more cash to service more transactions. Some things just increase naturally, and we can follow that. Some things increase only when we make long-term plans. If I start doing more business activity, my warehouse doesn't just grow automatically. I'm either going to build more warehouse or I'm not. So that's part of a long-term plan. In addition, part of forecasting balance sheet items is financing choices. How am I going to finance this expansion? Am I going to go out and borrow money, or am I going to not? Am I going to get new shareholder investment or not? I have to make a choice. It's a business choice. Now, in terms of forecasting income statement items, some things go up naturally with sales. If you sell more, your cost of goods sold goes up. It just happens automatically. You got to buy more stuff to sell. Depreciation expense, on the other hand, doesn't go up naturally with sales. It's tied to the level of property, plant, and equipment. And my interest expense is tied to the level of my interest-bearing debt. And my income tax expense does not go up with sales. It goes up with how much in my pre-tax income or my taxable income. It's more related to my tax rate. So there's some general principles here. Let's do a little detailed analysis on each one of these, shall we?